You have worked hard to build your retirement savings, envisioning a comfortable future. But did you know there are specific rules about when and how you can take money out of those accounts or risk losing a significant portion to penalties? It is a common pitfall that can surprisingly catch even careful planners off guard. The most straightforward way to avoid required minimum distribution penalties is by taking your distributions on time. These are called RMDs. This means withdrawing the correct amount from your retirement accounts each year, by the deadline set by the Internal Revenue Service. Failing to do so can result in a steep 25% excise tax on the amount you should have withdrawn, but did not. There are also important changes to know about RMDs that have recently taken effect. The reason these rules exist is to ensure that retirement savings, particularly those that have grown tax-deferred for years, eventually contribute to the tax base. The government allows your money to grow without immediate taxation, but eventually wants its share when you are retired. For most accounts, this requirement typically begins when you reach age 73. The rules help prevent these funds from becoming an indefinite tax shelter for future generations. To practically avoid these penalties, first clearly identify all your retirement accounts subject to RMDs, which generally include traditional IRAs, SEP-IRAs, Simple IRAs, and most 401(k) and 403(b) plans. Secondly, know your RMD start date, which is the year you turn 73. Third, calculate the correct distribution amount using the IRS Uniform Lifetime Table or work with your financial institution, as they often calculate this for you. Fourth, ensure you make the withdrawal before December 31st of each year, following your first RMD year. Remember, you can aggregate RMDs from multiple IRAs and take the total from just one, but 401(k) RMDs must be taken from each individual 401(k) account. One key insider detail to remember is the difference between a traditional IRA and a Roth IRA when it comes to RMDs. While traditional IRAs are subject to RMDs, Roth IRAs are not for the original owner during their lifetime. This is a significant advantage many people overlook. Also, if you are still working and not a 5% owner of the company sponsoring your 401(k), you might be able to delay RMDs from that specific 401(k) until you actually retire, even past age 73. This is known as the still working exception. Understanding and proactively managing your required minimum distributions is crucial for preserving your hard-earned retirement savings. By identifying your accounts, knowing your deadlines, and utilizing the available exceptions, you can confidently navigate these rules. This allows you to avoid unnecessary penalties, keeping more of your wealth intact, and ultimately ensuring a more secure and worry-free financial future for you and your family.